There are certain rules in your book, also in the handout that I gave you. It addresses it a little bit, but I thought these excerpts from your book were more specific. They actually are more specific than what I have in that particular outline. So if the exchange has commercial substance, we recognize gains and losses immediately. If it lacks commercial substance, and no cash is received, then we will not recognize the gain. We defer that. We don't recognize it immediately. We wait until later. But the losses are recognized immediately. Also, if it lacks commercial substance, but cash is received, then we'll recognize part of the gain, partial gain. But if there's a loss, we recognize it immediately. So notice in all cases, if there is a loss, whether it's commercial substance or no commercial substance, we recognize the loss immediately. It's when there is a gain and there's no commercial substance that we don't recognize the gain, or we recognize part of the gain. So here in illustration 1020, it goes over it a little again as well. So here's our process. Compute the total gain or loss on the transaction. This amount is equal to the difference between the fair value given up and the book value, fair value of the asset given up, and the book value of the asset given up. So we compare fair value of what we gave up with the book value of what we gave up. So we'll set up problem 8 to do that. If there is a loss, always recognize a loss. It doesn't matter. We don't have to figure out if there's commercial substance or not commercial substance. And I'll get into that here in just a little bit, what that means. Okay, and then it'll go through if there's commercial substance, we recognize the whole gain, but if it lacks commercial substance, then it depends on whether cash is received or not. If no cash is involved, no gain is recognized. If some cash is given up, no gain is recognized. And then lastly, if some cash is received, then a portion of the gain is recognized. So again, if there's no cash involved, we don't recognize the gain. But if there's some cash, then we're going to look at the gain will be recognized as the percentage of the cash received, right? We're going to look at the cash received, which sometimes is called boot. So the boot received, the cash received, divide that by the total consideration received. So we're going to get assets and we're going to get cash. So we add up everything we're receiving and its fair value. And so we're going to divide the cash received by everything we received. So what percentage is it? And that's the percent of the gain that we would recognize. Okay, so let's go look at your problem. Okay, so in problem 8, we have Holyfield Corporation wishes to exchange a machine used in operations. Holyfield has received the following offers. So we have one offer from Dorset Company to exchange a similar machine plus $23,000, and it's just telling us the exchange would have commercial substance. So let's go ahead and look at this particular option 1, because it wants us to look at there's 4 independent situations, and let's look at those. Okay, in situation 1, the transaction has commercial substance. What that means is that future cash flows will change as a result of this transaction. So the future cash flows are either going to grow or they're going to shrink as a result of the transaction. Well, why are we saying that? Why does that make a difference whether it has commercial substance? Well, if you think of, recall we said property, plant, and equipment is used in operations. And if it's used in operations, it's going to generate cash flows. So we're looking at those cash flows to determine if it affects these cash flows, that affects operations. That's that's commerce in essence. So that's why that's the test basis for a commercial substance. So it's going to affect, that's how we determine whether there's commercial substance. So I'm going to look at the consideration. When I say fair value of consideration, that's everything given up. So in this case, each of them are going to give up a machine. Holyfield is going to give up a machine, and it tells us its fair value is $92,000. So if we were to buy it somewhere else, our cash equivalent price is $92,000. Dorset's machine, though, only is worth $69,000. So since that's so much less, Dorset also has to pay cash of $23,000. And we can see then how this equalized the transaction. Dorset's going to give up $92,000 of consideration, a machine with cash. Now let's look at the book value and compare those. Well, book value is the original cost of the machine, and then we would subtract its accumulated depreciation to get the book value. So for Holyfield, the cost was $160,000. It gave accumulated depreciation to be $60,000. That's all in the narrative. So its book value is $100,000. For Dorset, for their machine, they originally paid $120,000. That's its cost, its historical cost. They have accumulated depreciation of $45,000, and thus they have a book value of $75,000. Now recall, Dorset also is going to pay cash of $23,000. So cash has a fair value of $23,000. It would have an accounting value, right? Accounting book value of $23,000. So $98,000. Okay, so let's figure out the gain or loss. Let's take the fair value and subtract the book value. In this case, Holyfield's getting $92,000, giving up $100,000, or the accounting value of $100,000. So it looks like they have a loss. They have an accounting loss of $8,000. Dorset, $92,000 less $98,000. They also have a loss, but their loss is $6,000. So let's look at how would Holyfield versus Dorset, how would they record this? Well, first off, Holyfield's going to get rid of their book value, right? So let's make the journal entries. They're going to get rid of their accumulated depreciation of $60,000 by debiting it. And they'll get rid of the original cost of the machine by crediting it for its cost. So this is what has been given up. So they gave up the $100,000 net book value. Now let's record what they have received. So they're also going to receive a new machine, right? They're going to get this machine from Dorset. So they have a new machine coming in, and it has a fair value of $69,000. And they're also going to get cash of $23,000. So let's note, total amount received is $92,000, and we are recording the fair value of what they're receiving. Okay? So we're going to record the fair value of what they received. Debits don't equal credits. We need another debit, which is a loss of $8,000. If you add up your debits, those will total $160,000. Let's do the same thing for Dorset. So Dorset, we want to get rid of its old stuff, the old book value. So let's get rid of those. $45,000 accumulated depreciation, and $120,000 the cost of the old machine. Then we want to record, they're going to get a new machine, right? So a new machine is coming in, and we're going to record it at fair value, $92,000. It's going to get recorded at fair value. I have two debits and a credit. I need another debit of $6,000 to balance, and that's the loss on this transaction. Okay, so there's the first one. Okay, so that's commercial substance, and we have losses that are recognized immediately. Okay, second alternative. Winston offered a similar machine. This exchange lacks commercial substance. So here's Winston, here's Winston, 152, 71, and 92. So let's go look at what's going to happen in this situation. And again, this lacks commercial substance. So if it lacks commercial substance, if there is a gain, it's real iffy on whether we'll report it. So let's see what's going to happen here. So again, what's given up? Well, we already know Holyfield's giving up a machine with a fair value of $92,000. They have an original cost of $160, accumulated depreciation of $60 for book value of $100. So this is exactly what we did before. We're just looking at fair value versus book value, and we have the $8,000 loss. And, we saw that all before. Winston, on the other hand, is giving up a machine that also has a fair value of $92,000. The original cost for Winston, was $152,000, with accumulated depreciation of $71,000. So they have a book value of $81,000. So we compare fair value with book value, and we actually have a positive number, $11,000 gain. Now remember, if there's no commercial substance, it depended on whether cash was involved, whether cash was received or not. And if there's no cash received, then if the answer to is cash received, if the answer is no, then we don't report a gain. So that's just the rules. So when there is a gain, when it lacks commercial substance, then it depends. If no cash is received, we don't report it. So we are going to defer recognizing that gain till the future. Okay, well, let's go through the journal entry. Let's record the loss for Holyfield. Again, we get rid of their old book value. So we get rid of the book value. We're going to record the new asset coming in. So we've got a machine, the new machine coming in. And we're going to report it at its fair value, $92,000. And our debits don't equal our credits. We need another debit of $8,000. That's a loss, which we show here as well. Okay, let's go on to Winston. Again, we want to get rid of its book value, the $152 and $71. Okay, now we have a gain which we will defer. So that means when we go to record the new machine, we're not going to record the new machine, right? Winston's going to get this machine from Holyfield, this $92,000 machine. We're not going to put $92,000 here. I'm actually just going to kind of plug it to make it balance. But there's a little more to it. So let me just write the word plug here, and then we'll talk about that a little bit. So I'm going to plug that to balance, but it's really, it's the $92,000 fair value, and I take out the gain. I'm not recognizing the gain. That's also really how we get that $81,000. Okay, so in this particular situation, when it lacks commercial substance, if there is a loss, we recognize it immediately. If there is a gain, we defer that gain. Okay, let's go to a third scenario. The third scenario is Liston. Here's Liston stuff. Liston offered to exchange a similar machine, but wanted $3,000 in addition to Holyfield's machine. So let's go look and see what's going to happen. Okay, we're back in number 3. This situation has commercial substance. So we're back to where if there's gains and losses, we recognize them both immediately. If there's a gain or loss, we recognize it immediately if it has commercial substance. And I went ahead and put in Holyfield stuff. They're giving up a machine with a fair value of $92, a book value of $100,000. Let's see. I actually need to see. They actually are also giving up cash, aren't they, of $3,000. So total consideration given up is $95,000. And book value, again, cash, it's market value, which is fair value, and its accounting value, which is its book value, are going to be the same. That's why in your book they really don't factor in, when they're doing this, the cash for fair value and cash for book value, because it really is a wash. But I For me, I like to look at the whole consideration given up, the whole consideration, book value, the consideration given up. Okay, so then we compare fair value with book value, and we get a loss again, $8,000. So for Holyfield, they're going to get rid of their book value, get rid of the accumulated depreciation and the cost of the old. They're going to record the new machine. And I actually don't know what to report here because I haven't listed out Liston yet, have I? So let's go look at that. So Liston, if you go to the information for them, they have a machine with a fair value of $95,000. So when we go down to here, we're going to record this as $95,000 at fair value. We also want to record that cash was given up, right? This $3,000. So credits minus debits. I need another $8,000 debit to balance. That's my loss. It's a debit or loss. And I didn't worry about, you can see, when I'm problem solving or you're problem solving, any accountant when you're problem solving, you often cannot solve for all my debits first and all my credits next. So when you're problem solving, don't worry that you have all your debits together and all your credits. Now, Wiley Plus will probably want you to enter it in with your debits first and your credits last. But when you're in the problem-solving mode, that's ridiculous to anticipate that you can do that. Let's go to Liston. Liston's going to give up an asset of $95,000 with the cost of $160,000 and accumulated depreciation of $75,000 for a book value of $85,000. So comparing fair value and book value, we have a gain of $10,000. And again, since it has commercial substance, we'll recognize that gain right away. So let's go do that. So for Liston, let's get rid of their book value. So I'm going to debit accumulated $75,000, credit the cost of the machine $160,000. We'll record the new machine at its fair value. Right, and they're going to get this $92,000 machine from Holyfield. So I am going to, oh, and let's see, they're also going to get cash, aren't they? Forgot about that. So they get the machine and they get cash of $3,000. Okay, so my debits and my credits, I actually need a $10,000 credit to balance, and that's my gain. Split that out so you don't get those transactions look the same. So I have 3 debits and 2 credits and equal out. Okay, so there's situation 3. So again, when it has commercial substance, I recognize both the losses get recognized immediately, and gains got recognized immediately. Okay, fourth scenario is actually a Greeley, who's a dealer. So now we have a dealership. So in order to obtain a new machine, Holyfield will pay $93,000. So really it's a trade-in, isn't it? Holyfield's trading in this old machine to buy new and pay cash with it. So let's look at what's going to happen there. Okay, so it has commercial substance and we have a dealer. So again, Holyfield's giving up a machine and cash. $93,000. So they are definitely upgrading. So total fair value given up is $185,000. Here's our book value. They're also giving up cash. $93,000. Total book value given up is $193,000. Okay, so I compare fair value with book value, and as always, we have this loss of $8,000. Greeley, the dealer, has the machine for sale for $185,000, so that's its fair value, and it has its in inventory for $130,000. Now notice for Greeley, this machine is not property, plant, and equipment. It's actually inventory for Greeley, because that's what they're a dealer. They're in business for selling machines. So this machine is actually an item of inventory for Greeley. So Greeley is actually, going to sell it for $185,000. It cost $130,000. So they really have a profit or a gain of $55,000. So it is a gain, right? It has commercial substance. So we're going to recognize that gain immediately. Now, since it's a dealer, I'm not really going to call it a gain. It's actually going to end up being on the income statement, gross profit, right? Sales less cost of goods sold is gross profit. And I'll show you how we'll get the sales and cost of goods sold into the accounts. And again, it's because it's a dealer that it's not going to be, an operating gain. It's actually going to be gross profit. Well, let's go ahead and do Holyfield like we've been doing. Holyfield also going to give up this old equipment, going to give up cash of $93,000. A new machine will come in. We'll report that at fair value. New machine has a fair value of $185,000. And then we also are going to have a loss. They really will have a loss on this transaction. Sorry about this. Having trouble getting up to myself. $8,000. Okay, so we have 3 debits and 2 credits. Now let's look at the dealer. Well, actually, for the dealer, we really don't have this. It's actually inventory given up. So we're going to have cost of goods sold. Our expense account, cost of goods sold. For the cost of the inventory, $130,000. What am I doing there? $130,000. And credit inventory, $130,000. So we remove the inventory and expense it in cost of goods sold. Cash will come in. We're going to get $93,000. They're going to get, right from Holyfield, they're going to get a piece of equipment. That'll go in their used equipment inventory. And again, that's really probably used equipment inventory instead of the new. So used equipment inventory for $92,000. And we'll record sales. That's going to be our selling price, $185,000. So on the income statement, we will have sales, $185,000. Okay, here we go. Sales, $185,000. We would subtract out cost of goods sold, $130,000. And there's our gross profit, $55,000. Just like I had said earlier, we would have gross profit. Okay, so there goes through, a lot of different scenarios for a non-monetary exchange.